Why were homes foreclosed during the 2008 market collapse? Imagine waking up one day to find your house worth less than what you owe on your mortgage. That was the reality for many homeowners during the 2008 financial crisis. This period was marked by a sudden and sharp drop in housing prices, which caused a wave of foreclosures across the country. But why did so many homes end up in foreclosure during this time? Let's break it down. Before the collapse, lenders were issuing a lot of risky loans called subprime mortgages. These loans were given to people with poor credit or limited income. Many of these mortgages had adjustable rates that started low but could increase sharply after a few years. When interest rates reset, homeowners faced much higher monthly payments they couldn't afford. As a result, many defaulted on their loans. At the same time, housing prices had been inflated by speculation. People bought homes expecting prices to keep rising, often without considering if they could afford the homes long term. This created a housing bubble where home values soared well beyond their real worth. When the bubble burst, prices fell more than 20% from their peak in mid-2006. This left many homeowners with negative equity, meaning they owed more than their homes were now worth. Because of this negative equity, some homeowners chose to stop paying their mortgages. Since many loans were secured by the house itself, lenders could foreclose if payments weren't made. When home values dropped, the risk of losing money increased for lenders, leading to more aggressive foreclosure actions. Another factor was the complex financial products called mortgage-backed securities. Banks bundled thousands of these risky mortgages into securities and sold them to investors around the world. When homeowners defaulted, the value of these securities plummeted, causing huge losses for financial institutions. This financial turmoil made it harder for people to get new loans, and existing loans became more difficult to manage. As the crisis worsened, more homeowners fell behind on their payments. By 2008, foreclosure rates had more than doubled from previous years. The housing market was flooded with homes for sale, pushing prices even lower. The economic downturn also caused many people to lose their jobs, reducing their income and making mortgage payments impossible. In the end, homes were foreclosed during the 2008 market collapse because of a mix of risky lending, overinflated home prices, and the subsequent fall in values. When homeowners owed more than their homes were worth and couldn't keep up with payments, foreclosures increased. This chain reaction contributed to the severe economic downturn we remember as the financial crisis. It showed how interconnected the housing market, lending practices, and global finance really are.